So today we are going to talk about stock valuation, which is a very important skill, which is very critical in today's market. In today's market, you might be seeing, stocks are rising like anything, but then people are scared. And what has become very important is to understand what is the underlying value of these stocks, and is it justifying the growth that is happening. So we are going to be unraveling, what valuation is about, how you can value a company, and give you some practical examples in this process. So why does valuation matter, right? All the prices, all the stocks that you're seeing are actually linked to the underlying companies, right? People buy a stock because it represents a certain value, right? So while picking trends is super interesting, and it's very fun, but at the end of the day, the stock's price appreciation is totally dependent on its underlying value. So if you look at any stock that you might have seen appreciate, you would see that people come and talk about the underlying reason, right? Let's say railway stocks are rising. That is because the government is putting in money into the railways, so the underlying value of the railway system is increasing, right? And there are certain companies which are benefiting because of that. Similarly, for any other sector or that you might be looking at, there are other valuation reasons that will govern that stock. So let's understand the basic valuation ratio, right? First one, which is very common, is the PE ratio, which is price divided by the earnings, right? So depending on the historical trends, we see that even the index, the Nifty, and various stocks, they tend to maintain a historical PE ratio, price to earning ratio. Any stock that is getting a little bit overvalued, right, whose value is increasing relative to its underlying, we'll see that PE ratio increases rapidly, right? While the earnings haven't risen, the price is rising rapidly. Similarly, any stock that is undervalued would have a lower PE ratio, right? Price is low, but earnings are high. So a typical value investor would go and pick the stock that has low PE ratios. But then there are other things also. Sometimes when people are expecting good future prospects, so while earnings are historical, prospects are in the future. So people might see that, okay, they don't care about PE ratio, they're betting on the price because they think good prospect. There are various nuances to it. You have to understand, these things to be able to invest based on the PE ratio. Now, the second ratio that is very popular again is the PB ratio, right? The PB ratio is price divided by book value. Book value is the underlying value of all the assets on the balance sheet, right? And people try to look at the PB ratio to get a greater sense of the valuation of certain sectors, right? Another ratio that people try to look at is the PEG ratio, what means price by earning by growth, right? So that is also a very fair metric through which people try to evaluate the valuation of stocks and try to pick up stocks that are not overvalued, and whose price is justifying the earnings, and also the growth is also justifying the PE ratio that they are demanding. Another important thing to note here is to understand the relation between PE ratio and the earning growth, right? Sometimes a high earning growth can actually justify PE ratio being high. So PE ratio being high is not always bad. Any stock that is on a exponential growth trajectory, a very fast growth trajectory, will tend to have a high PE ratio. There will be a lot of demand for that particular stock, and prices will appreciate. But the key thing is that the earning growth that is happening, like the growth that the company is actually showing, should be able to justify those numbers. Otherwise, it looks like a bubble territory, right? So if you look at the example of the internet or the e-commerce IPOs that came, a couple of years back, everybody was a little bit concerned about them because they thought, okay, they're demanding such high valuation, but where is the earning growth? And slowly, if you look at example of Zomato, as the earning growth has picked up, it has been able to justify the PE ratios, and that's why you're seeing there's so much demand on Zomato or delivery and stocks like that. So there's a very key relationship between PE ratio and the earning growth, which is critical to understand. So there are various examples where looking at valuation and this PE ratio or PB ratio has been extremely useful in picking stocks. We talked about the e-commerce stocks like Zomato, delivery, which have done really well because they are showing this strong growth. Similarly, if you look at a year back, people who were picking PSU banks, right? Those were also undervalued stocks. So, the prices were not very high like private banks, but then the underlying value was increasing because of the reforms happening in the banking industry, right? So people identified PSU stocks, PSU bank stocks at undervalued stocks, And if you picked it up, let's say more than a year back in the beginning of 2023, then that was an amazing value buy. Right, so identifying which key industries, sectors, or single stocks that have good valuation can be an incredible opportunity for you to bet on. And like we said, there are investors, these people who actually go and visit smaller companies and do the in-depth analysis. They are actually trying to identify the long-term value in betting based on it. So that's also an example of value investing. So there are also various pitfalls of value investing, right? See, looking at PE ratio as one source of truth can be dangerous because PE ratio is based on historical earning, right? And what you actually have to be able to do is invest based on their future prospects. So relying only on historical data can be a little bit dangerous. What you also have to do is do some sort of analysis that helps you project the future earnings, or you rely with analysts who are giving you those projections and base your valuation ratios on future prospects. So to give you an example, let's look at the chemical stocks. The chemical stocks had a very great run just after COVID, right? But then there was so while at that point in time they looked extremely attractive, soon we saw that the earning growth wasn't there and the whole sector sort of stagnated for a while. So you always, if you had an outlook on the future growth, what's happening in the macroeconomic scenario, and you bet based on that, then you could have exited the sector at the right time. So understanding the future prospects is extremely important. So sentiment also is a huge role to play when you're doing value investing. I think sentiment is extremely important in different cycles in the market. When you are in a bull market, like let's say example of last year, nobody cares about value, right? People just care about the returns that are coming because the growth has picked up. So during that time, people tend to ignore value, and then at a top, when the valuation become a little bit too expensive, that is when the panic starts to happen. So understanding where we are in the cycle and betting according to that is extremely important when you are doing this type of investing, right? So the importance of valuation is extremely different in different cycles, right? Different stages of the cycle. In a bull market, okay, people tend to ignore the valuation, but when the bull market ends or stagnates, that is where the value comes into play. Let's look at an example of, let's say, the railway and defense stocks. Well, last year everybody was just discovering these stocks and buying into it. Right now everybody is concerned that is the value being justified, because you've seen 200-300% growth. So different stages of the cycle, valuation has different roles. So there are various tips that I would like to provide to investors that will help them in their value investing journey. See, number one is that while we are relying on these PE, PB ratios, they are not one source of truth. Try to look at various ways of identifying value stocks. That would be one. Second would be that PE ratios are based on historical earnings. So get a projection of the future also. Try to understand the broader picture, and let's not just rely on one data point that came in the past. And then understanding the sentiment in the market or the stages of the cycle is also extremely important. In one stage of the cycle, you can discount valuation and go with highly valued stocks, but in certain other stage of the cycle, you will have to put extreme importance on value investing, right? So understanding this is extremely important. And I think if you get a good sense of the holistic picture about valuation, that will make you a much better investor. So to master stock valuation, I think you really have to have a holistic approach. You definitely need to understand the valuation, but you also have to have an outlook on the broader market picture and the sentiment and the stage in the cycle that we are. And a holistic approach will make you a better value investor. So I hope you liked this video and you understood the concepts of value investing with our discussion. If you like this video, please do go and hit the like button. Write down in the comment what you would like us to talk next, and please subscribe to our channel.